All right, hello guys, and glad to have you on board again today. This is one that I had in a pipeline for quite some time, just couldn't figure out the appropriate time to do it. And I think today is the appropriate timing. So we've matured quite a bit into building the bottom, and I think now we've had clear evidence that the bottom is likely in, though still not yet 100% guaranteed, but lots of points suggesting it is. So we've seen the usual pumps. So as you can see, things, even today, I mean, double-digit gains on tokens with questionable values still is the same old story to me. So I thought it was an appropriate time to stop just shitting on bad projects and to just share with you guys the checklist that I have to define which projects are actually worth it. So I've always said it, 95% of crypto is full of shit. There's definitely a crypto bubble, and I would definitely agree with those who say it. The problem is that, well, there is a crypto bubble in which 5% of tokens are going to be absolutely useful and very used, widely used, and therefore their actual relative valuation is very undermined today due to the relative low adoption rate which we're in. I mean, so much more adoption is coming down the line for those who actually serve a purpose and have a real use case. Though today I'm going to explain how I do answer these questions. Is this thing really worth it? And I have a clear set of rules that do it. And like I said, I'm not going to shit on the project that I think absolutely don't pass that test. I'm just going to show you which one does pass it for me. And then, of course, you do your own choices. All right? So this is my model. I would like to say it's not a perfect model, just like any model available out there. But it is a pretty well-crafted one. I tried to use different sources to kind of cross things together to make sure that, well, if someone is filtered out unduly, well, that's a miss, of course. Some good projects will be filtered out because of this system. But the thing is that, well, yes, I mean, better like to be safe and sound than diversifying endlessly. All right. And on the opposite end, of course, there's definitely some shitty projects that will be able to pass through. But the thing is that I'm trying to get it to the definitely good grain size to get it fulfilling my needs. All right. So without further ado, let's jump in. I'll try to make this one quick. So it is a 7-step system. The first 2 steps can be avoided for those who don't give a fuck about investing in value, who just want to, okay, pump and dump. I don't care holding the tokens. I don't like to buy and sell quickly, which to me is a very dangerous bias, but we'll get to it in the end. All right, so step 1, to me, crucial one, is I take the list. I'm going to do it for the first 100 coins in here, and of course you can extend that to just as low as you want. Number 1 question to me is, have I ever used this thing, or do I intend to use it in the very near future, like couples of weeks or stuff like that? All right, is this something that I intend to use or not? So nope. Audio, I did kind of tried it one time, found it very less useful than SoundCloud, so I kind of said, yeah, not good today. Maybe in the future, but not today. T-Fuel did use it indirectly in Ethereum services as well. Nope. Nexo did use it. Kava never. DYDX did try it. Osmo use it every day. No. As you can see, I mean, just look at that list. I mean, for more than 50 projects, there's probably 90% of them have gone out. So this is really dramatic filtering in here. Pancake Swap, been using it. Nope. Geez, Injective did try it back then. Curve Finance did use it. Nope. Theta, been using it. Aave. Immutabilix, I'm intending to try that one to see for myself, though for now it's not a check. Okay, let's make it clear. Nope. Oh, yep. Monero did try to send a few transactions to see how good the network was. Not an easy thing to handle, but once you got it, it's pretty damn fucking efficient. Atom, using it almost every day. Chainlink, using it indirectly through Aves, Unis, and the like. Uniswap, AVAX, did use it back then, no longer today, but used it. Tron used it as well back then to transfer between two exchanges. So this is not the craziest use case, but still use case. Polkadot, never tried, but I know it's a good project. Solana did try once back then, wasn't very convinced with the user interfaces. So I used it to buy a shit coin, took a quick buck on here, and then deleted the wallet, which I see so many people, saying Phantom is great. I really didn't see it. Okay, Matic, pretty used as well to transfer tokens from exchanges. So kind of a transfer layer, all right, just like Tron. So there are some use cases for this, but I will use one, not both of them, all right? Dogecoin did buy some of that full of shit coin back then, but like I said, absolutely no utility unless you think this is going to be Mars money or whatever shit like that. Could have some use cases today, but I don't nearly think they will ever pass the... Anyway, the other steps will filter out Dogecoin. Cardano never used it. Ripple never used it. Binance Smart Chain using it lots of times. Ethereum, of course, as well. And Bitcoin using it very few times, but Bitcoin, we don't want to use it. And remember, Bitcoin's actual store of value use case is to have very little to no utility. That's the basis case layer for store of values. So Bitcoin is kind of a separate asset. All of the other ones, yeah, they are kind of securities. They are investments in speculative vehicles, all right, in financial instruments. Though the number one stuff that I'm going to break down in here is to, when we say security, that doesn't mean the stupid way of SEC enforcement of regulating and destroying everything. It just means they are true securities in the sense that they are financial instruments. In that sense, well, they should have an associated value. They should give us some data sets to confirm that value and stuff like that. In that sense, I totally agree with Gary and the folks at the SEC that this is the fucking freaking Wild West out there, in the sense that basically anybody can deploy a token. Does it actually have any use case? Who gives a fuck? Is it even serving an economic model, a blockchain token? No, actually, no. You can launch your token on any existing blockchain. It's just basically... a limited number of assets, and people give it a value because of scarcity itself. Oh, no, like we said, use cases, absolutely number one rule of safety here. If you never use the product, you rather like to question why the fuck do you want to buy it, all right? That's really the way it is, all right? So number one thing, do you ever, have you ever used it or intend to use it in the short run with a clear use case for you? Okay, it's not just like I want to buy the token, so I'm going to use the thing. Okay, so it's really not the way it is. Most actually of these things you can't even use them yourself. All right, so we'll see about that. Now, step two to me is the blockchain shit. So it's really the way it is. You have to answer that very simple, yet no one does it, question. Do you actually fucking need a blockchain for this service? Remember, every blockchain that doesn't serve a clear, simple purpose service is pointless, all right? You should be able to answer whatever that blockchain does in a single word, all right? Like Ethereum, smart contract, okay? Or that's really the way it is, okay? Simple stuff. I need to be able to answer this thing, like Oracle, interoperability, privacy, okay? Easy stuff, okay? That's the way it is, okay? I need to be able to answer in a simple straight line what this thing does, otherwise problem. Once I know this thing that it does, the number two question is following this kind of guideline sets of rules, all right? So this is kind of, yeah, guidelines that will prevent you from buying a thing that doesn't have economic intrinsic value. So this thing is helping me to figure out if this thing truly has a reason to be a valuable project or if this is just full of shit. That doesn't necessarily mean it isn't today and will never be in the future. But the thing is that, well, once again, in a what so distant future, this thing is actually going to have the sufficient market shares and revenue stream to compensate for the extreme cost of deploying a blockchain. Because most of the time, well, you're not going to be able to answer that question. Or it's going to be, yeah, eventually in a distant future. Yeah, you know what? I've heard that a lot. That's exactly the number one narrative, to sell shit to people in a bubble, which means there are lots of people who don't know whatever they're talking about, and you can just basically sell them whatever shit, as long as you use the magic world, blockchain, or NFTs, or any of those shit shows that people don't understand anything about. So if you truly want to invest into something, or even trade, you need to make sure there are values into these assets, and in order to define that, use case is a good starting point. Number two is to figure out the economic model. Is it viable or not? So Can you articulate a real business problem that needs solving? I would like to say in here, first filter is whatever shitty projects have metaverse in their name or do serve a purpose in the metaverse. Jesus fucking Christ. I mean, they're not even a metaverse today. So can we at least be serious for a second? Anything that is metaverse shit, whatever, just dump it. Garbage, absolute garbage. First, I'd like to see a metaverse. Then we can actually start to talk about it. Okay, so selling future shit at a tremendous bonus today. Good luck with that. Could it have been fixed before blockchains? Most of the problems are actually solved already, which means we have blockchain replicate of existing solutions. Though I don't like. If the answer is yes to that problem, you can immediately switch to this area, which to me is, well, if you have blockchain, why do you need it? The reason why is you need to answer all of the intermediary question, but most of the time, 99% of the time, this is where these things will fail. Does the benefit justify the cost? Okay, the benefits, we all know that. I hope you know what a blockchain is, a distributed ledger technology, and stuff like that. So understand that basically, if the solution already exists, it probably exists in a solution that we call either a centralized or shared database. Okay, which means basically this is a central database or a shared database shared among and synchronized among multiple participants, all right? So that's the way it is. And this system, well, works pretty damn fucking well already, okay? The problem is that if the actual market participants have ununified interest, which means someone could eventually try to cheat, well, there is a problem. But whenever that problem shows up, 99% of the time in the fucking real world, we solve that problem by introducing a trusted third party, which will look at everyone's activity and say, okay, everyone's been behaving correctly, so the state is okay. And this trusted third party generally brings a collateral on the table to make sure that if it cheats itself, it's going to be destroyed, that collateral, to compensate for the loss in the general shared state. Okay, so that's the way it is. Most of the fucking time, this works damn great. So how the heck do we need a blockchain when all of this just can't work out on its own? Which means either this guy has to bring so much collateral to the table that, well, it starts to question its own values, which means maybe this guy could actually start cheating as well on the whole system, all right? So that's really the way it is. When you cannot even trust a third party, okay, you need to ask yourself that question. Will all the participants need to upgrade and maintain the system? If that's the case, which I think blockchain requires, okay, the thing is, boy, it costs a fucking lot. Let's make it very clear and straightforward. A centralized or shared database system, it's basically, you're going to replicate that database to how many people are actually using it, meaning reading and writing on that database. Most of the time, yeah, it's somewhere like 10 to 12 participants at best, and it's very easy to coordinate. And if there are collateral problems, then we generally use a third party to scroll over the overall activity. And that's it, all right? Though now the thing is, well, in a blockchain version of it, which means you take an existing business and you try to blockchainize it, okay? How to filter out the shit from the actual true value economics. It's exactly the same as if you compare it to the 2000 era of the actual internet. There were tremendous value being brought by using internet on a business. But the thing is that not every business could actually profit from an internet, but yet everybody was buying irrationally everything that has a .com. So in that sense, I totally agree that there is a bubble with crypto. People buy this thing just because there's a blockchain word in here, but most of the time, the blockchain itself doesn't serve any marginal improve in the existing solutions, all right? Which means most of the time, a fucking centralized or shared database does much more than actual distributed ledgers. Otherwise, well, the thing is that you're going to have decentralization at the core. Otherwise, I mean, what's the point of having a blockchain if it's not decentralized? So you're going to have hundreds, thousands of nodes, which means now your centralized database is replicated 1,000 times, which causes just one problem. I'm going to go immediately down this one. It targets a very few limited assets, but if you ever bought into any of these, be very, very careful. Any project that sells a 100K plus TPS, okay, to me, it immediately infringes the previous rules, okay? What are the real world use cases requiring so much collateral to justify 100 transactions per second? I see only one single use case. the stock exchange, which can require high transaction speed at some point in time, like when the market opens and stuff, when the transactions are like flushed into the market at a tremendous rate. Even though we should even ask ourselves, do we actually need that financial system with that many transactions? To me, I don't necessarily agree with that. But anyway, that's the only use case. That's the only reason why I've always said I'm still okay with Solana if it solves its problem, because that seems to me like the only candidate who could ever be able to achieve that someday. But every other fucking blockchain who pretends, I mean, that's how I filter it. I go to the website of that thing. If I see 100k TPS or any reference to high speed and infinite, I delete immediately, because I know it serves actually no real world use cases. These guys are genuinely selling you the future of, yeah, but in the future, we're going to need those TPS. I mean, no, we don't, all right? We can eventually need it in 100 different blockchains, which means the accumulated TPS of those 100 blockchains might be 100k TPS, but certainly not under the same hood. Otherwise, same old problem, you're centralizing 100k transaction. If for whatever reason your network isn't stable, you're going to be a centralized point of failure. So, absolute full of shit. 100k TPS, oh Jesus, I laugh out so loud at this. Eventually, 10 years from now, it might be a reality, but how the fuck can you sell that to me today? Not actually worth it. So any 100k TPS software, just go fuck yourself, all right? That's really the way it is to me. But it is in the end already. If you can figure out it all that far, first of all, congratulations, that's great, but that's still not the end of it. Depending on the remainder stuff, the thing is that you're going to have to separate between hybrid, private, and public blockchain. Understand one thing in here, that private blockchain is something you'll never ever get to use directly, which means those private blockchains are generally used through the help of a front end, which means you will use an application on a centralized front end, which will integrate with a private network of blockchain that interacts with some other private sector entities. Okay, that's how companies could exchange and trade data in a secure way without trust. That is something that definitely has absolutely tremendous market shares, but how do you want to participate in this? Do you really think that private network is going to launch a public token? Are you fucking stupid or what? No, it isn't. So everything that says we're going to capitalize on private, oh man, I got a word just coming to my face now. I mean, you probably know which projects I'm mentioning now, who sells the private network adoption and sells a token for it. Jesus fucking Christ, this is a scam, not to say the least, all right? It really, really makes no economical sense to see that project in the top 20 or 30. Anyway, not mentioning any names, but you probably know which one I'm talking about. Public networks are the ones which will sell a public token. And remember step number one, you rather like to be actually someone using this fucking service yourself, because that's the goddamn business model of blockchain, to make the users owning a part of the networks they're using. So be part of it. So I would say these are the things you should go for, all right? So they should be based on use cases and stuff like that, okay? Hope you know that. This is the final cheat show for me, okay? Private networks value capture, not that much, all right? It's really not the way it is. Private network doesn't like to commingle stuff with the public. Though the hybrid versions, I would say eventually some niche use cases, but most of the time private is none of your business. You just can't go there. Though target where you can actually get some value. Public blockchains, that means public service. That means you'd rather like to use that fucking service if you want to be part of it, okay? So we have it, okay? This is step 1 and 2. So if you used one software or blockchain or applications or whatever, make sure it serves a real world use case purpose. Make sure that the actual business model is reliable, which means the cost of replicating the ledger a high numbers of times is actually worth it. Because 100k TPS, I mean, Jesus fuck, where do you store all that data? That means you have to horizontally replicate that thing 1,000 fucking times. So 1 byte of data is gonna take just as much as 1 megabyte of data on your distributed technology. So it's 1,000 times the cost of storage. So Jesus, man, makes no sense, okay? Unless there is a tremendous value on the data that is transferred, which means the collateral value of the data that is transferred or stored is critically sensitive. Sensitive enough to justify the 100,000 multiplier of the costs. Otherwise, Jesus, maybe trust is a solution, all right? So that's really the way it is. Step 3 now, okay, is if you've passed those 2 steps, that doesn't mean your token is worth investing in at all because, well, there are 3, 4, and 5, okay? And 6, which to me are belonging to the same sector, all right? These are things you should already be familiar with because we've mentioned that before on the value crisis kind of video. How do you define value in a fundamental trading side? Because remember, price doesn't necessarily mean value. In order to transform price action into potential relative guesstimate of value, you need to figure out 4 steps. The first one is, yeah, you need to have a bit of history, which means, well, value settles itself as price trade over time. So you need at least a minimum threshold of time to consider this asset might have what could be a potential beginning for value. To me, well, that's at least 3 months of trading. I don't trade any token that has less than 3 months of lifespan. This is too volatilely, stupidly dangerous in the first stages. Too much risk to trade anything that has less of 3 months existence. So minimum lifespan to me. All right, the longer the better. All right, then minimum volume traded regarding the official market cap. So if I have a $1 billion market cap and for whatever reason the volume traded is not sufficient, very dangerous red flag to me. All right, that means this is probably a pump. Okay, though volume related to historical volume. If for whatever reason there's absolutely no volume and boom, suddenly a spike. I mean, you know what it is, pump and dump, Jesus fucking Christ. I mean, no one gave a fuck about this thing until for whatever reason someone started pumping it. So very dangerous stuff, okay? Get the hell out of it. Volume needs to be consistent. Of course, it's not the linear stuff, but you must not see some big spike of volume coming out of nowhere after absolutely no use cases before, all right? A big red flag. 5 is there to me to make sure that 3 and 4 haven't been manipulated, because there's one thing that I know for sure is that, well, market making can be very, very painfully kind of exchanging back and forth the same token thousands or millions of times by an exchange, which basically just creates fake volume. So volume can be fakely traded. That's not a myth, all right? That's really a reality. So in order to make sure that you're not being volume manipulated by whatever broker or centralized party there is, you need to make sure that a significant share of the supply has moved. Remember back then, I warned you, below 10% of supply circulating, it's very dangerous. That means the price doesn't correlate to value. That's what I said for Bitcoin when it gone below 10% circulating supply in exchange. I said back then, the prices you see are full of shit. The value just can't be assessed out of these traded prices, all right? And 6, last but not least, all right? Once you've got a significant enough share of the supply circulating with sufficient enough volume to say, yeah, maybe this market cap could be valuable, and you have sufficient history to stabilize prices after the initial ICO or IPO or whatever the fuck you want to call that, you need to make sure with an additional final stage, which is how the fucking supply is distributed. Because you may see 5-10% of the supply circulating, but if that's the same entity controlling those tokens who've made the same old actions back and forth, then actually, well, that's the thing, all right? So you need to make sure that when the supply moves, it moves on a wide range of wallets, which doesn't have interconnected relationships, all right? Because for whatever reason, if one entity who controls 20% of the supply just says, okay, I'm going to create 1,000 wallets, and then with those 1,000 wallets, I'm going to circulate from wallet 1 to wallet 2 to 3 to 4, 5, and back and forth, and I'm circulating this thing around. I can create fake volume with significant market shares moving without you even being able to see it. So the only way to make sure that you're not going to be someone else's stupid liquidity, make sure these 4 steps are there. That means cheating that thing is absolutely very ridiculously complicated to do, all right? That doesn't mean it's unbreachable. It can be like everything, but the thing is it requires tremendous coordination to do this, all right? So this is, to me, I've always traded that one from top to bottom, from bottom to top, which means I've always checked the tokenomics first, all right? I have a quick look at the volume. If there are some anomalies in the volume, history first, okay, then volume, but these ones can quickly be erased or flushed away if there are some problems. Then I generally tend to care of 5 and 6 at the same time by looking at the token supply and the token distribution. If a genesis or close to genesis, one entity had more than 20% distributed to them without vesting schedule, that's a big no-no, okay? And moreover, if there are centralized entities like the companies or VC investors or the team. They generally take some marginal big shares of the networks, and they need to have very, very long vesting schedule. And if there's ever inflation in that blockchain, they must not be part of it. Otherwise, over time, they maintain their purchasing power, which means they retain their grip on the market. A centralized market, just go back to the initial stuff, all right? If there is a centralized distributed system of value, then once again, aren't the interests unified? And if that's the case, the fuck you need a token, all right? You might need a token between few trusted third parties, but in that sense, why the heck are you listing that token in public exchanges, all right? If that's to serve private purposes, the token isn't for you to buy, all right? So what you're buying in here is buying your stake into a system which you have absolutely no use cases, all right? And that means those guys who actually control the supply, who do you think you are for them? The cool third party who helps pumping the price? No, you're generally the fucking exit liquidity, which means these guys control the prices and they can pump, dump, give you this feeling that you have to get in because it's going up or whatever. When they start unwinding 25% of the supply, you know what it does? Tanking everything. I'm just giving you the numbers, okay? In a relatively public listed security, in stock exchanges of some sort, even the bigger concentration generally rarely exists somewhere like 10 to 15%. That means one investor holds 15% of the supply of shares of one company, okay? Though on one end, that's what we call a majority shareholder, which generally has a sit at the board of directors and stuff like that. So in that sense, well, what do you do with that? The guarantee you have in a security exchange is that you know these guys will be forced to publish audited earnings reports and stuff like that. Do you have any such a thing on the fucking projects you're buying in here? Absolute transparency? No, not at all. Most of them don't say anything. You don't know where the money's going. You don't know anything about the use of proceeds. The actual transparency is close to zero. So on that sense, you're buying into a security, exactly, which means you're buying into a company which you don't even use the services or participate in the services. You expect this company to create profits. And in that front, boy, I definitely agree with Gary Gensler. Where I disagree with Gary is that it makes this a general purpose of every blockchain is a fucking security. No, it's not. Every token is not a security. There are 5% of them who actually exclude those rules, and these are the ones you should trade on. All right? The actual final stage, the 7 points, is pure straightforward. It means when you've crossed all the 6 ones, you need to check a technical analysis. Because, well, now that you have checked all those previous rules, you know that probably the price you're going to be seeing might have underlying value. And that if this asset has good utility and market potential, well, the actual value could be profitable over time. Which means prices can oscillate the fuck they want, but over time the value is supposed to increase, which is a definitely good point to score. Okay, that means the odds aren't randomly 50-50. Worse, like we stated, those who have deteriorating value means the longer you stay in your trade, the more odds for you to lose the money in the end. When you have a rising value asset, well, you can pay attention to timing. Trading is always against timing, but you're gonna have time profiting you instead of the opposite way around. So now that you know all of this, if you have 100 units of accounts, be it fiat currency or whatever, okay? Just doesn't matter the amount. Where do you want to park them? Into assets which you don't really study, which are actually private companies launching tokens that you don't use, selling whichever future use cases, which are actually most of the time already served by centralized entities, which do extract some margins out of their services, but there's no way the extra cost of blockchain can actually compete with such margins. So actually, like we stated, we've got existing business models that are more efficient than the one that have the magic blockchain world on top of it. So who's going to win? Definitely this one's going to lose value. That's the way it is. Well, rational common sense would tell you to actually go for these assets. But the reality is that, like we stated earlier, we're in the early stages of recovery in this market. But what I tend to say on a day-to-day basis is, I'm not mentioning any names, but I mean, just taking whatever today has a double digits. And they're certainly not the only ones, okay? But you see those things, they don't behave any close to whatever the rest of the market does. I mean, just look at them, okay? Same thing for this. You see them, they diverge. They absolutely don't trade like the other assets, all right? So why is that? Why is that? These tokens, none of them actually pass my filter. So these are actually down value over time kinds of assets. Like we said, the filter isn't perfect. Maybe one of them will prove me wrong, but there is very limited to no chance that all of them are actually good assets. So they have, in bulk, more downside probabilities over time because their market shares are not there. They're not market fit. They solve problems that could be solved with more efficient ways or already solved. And in that perspective, well, these are the ones people tend to trade today. When the rational sense will say, if you want to trade something, at least try to try these. There are not that many of them. There are like 5, 10, 20 assets that can be traded that way. And I see traders going the opposite way around. And that scares the fuck out of me. Because the message is the same old story. There are people out there looking from the distance who say, yeah, crypto is a bubble. It's all going down to zero. And I would like to say that the more I see the market behaving that way, the more I agree with them. There's definitely a bubble. And this thing is that these are carefully crafted price manipulation, to be honest, most of the time. I mean, very few could be the exceptions. But despite that, most of them are just absolute bomber type of price manipulation. People jump and fall for it just because they want to get rich quick or whatever. Like I said, you can do whatever the fuck you want if you trade. The only thing you need to make sure of is to at least check 3, 4, 5, 6, and 7. Though that means, yeah, I'm okay you trading like render tokens, multiversics, or whatever, thing like that, okay? Do it. But be assured of understanding whatever the message has sent you today, all right? That doesn't mean, yeah, don't trade this, okay? You do it to your own choices. Like I said, I have 100 units of account to invest, and my rational choice is to put them into the 5% which value rises. They might not be the one that rise as quickly as these things, but the thing is that I profit with value, which means, well, if I can time my entries correctly, I'm certainly not going to make a 30% pump in 24 hours, but I have the guarantee and I can sleep well at night knowing that these things simply won't go down. And if they go down, they will always go up afterwards. I don't fear the pump, I don't fear the dump, I just need to put my stop loss further away for this absolutely chaotic mess that trading is to be sure not to take my stop loss if I put one. Most of the time, like I said, the returns on investment for these assets are so big. I mean, remember that if you make a valuation model, most of them can do 3, 4, 5, 10x at best over the next couple of years. These are rewards you rarely see anywhere else. So that's the thing. You need to put yourself in front of the reality. Making an asset 30% higher in a day isn't the rule, it's the exception. So you can try to play that game of pumps and dump schemes endlessly. The only thing you're going to end up with is being an addict. Because you're going to be willing to get those pumps, those flushes of adrenalines and stuff like that. You're going to end up being druggy. I know the shit I'm talking about. There's so many people in cryptos, and this is happening even more when we have bubble environment, and I can say that for sure. The data I see in front of me today suggests another crypto bubble is already starting to form, even though all my models tends to say it shouldn't be the case. All right, I've warned you multiple fucking times. The next cycle for the good projects, the ones that are truly decentralized, serve truly purpose and use cases, they are probably into these stages of maturity, which means early adopters are coming along the way. Early adopters are people, okay, who enjoy innovation and comfortable. The early majority is made up of pragmatists who adopt new innovation only after it is proven and they feel comfortable that they won't put them at risk. Okay, remember that. The people that are coming are not going to buy these shitty tokens. The pumpers and dumpers, this was so 2021. Go back there again, and I wish you good luck. Don't be someone else's exit liquidity. And if you do it, understand that time plays against you. The longer you stay, the more dangerous it gets. So try to be smarter than that, folks, all right? I shared my cheat sheet. You can build your own. You can inspire from mine. It's free to take, all right? That's the way it is, but have one. If you don't select the project, and if you just go like whatever beginners generally tend to do, is opening the top and looking at the tokens that pump the most and say, oh, I'm going to buy them. Good luck with that. If they pump, that doesn't mean they're good projects. That just means, well, might be artificial pumps meant to attract even more pumpers. And when the last pumper is here, only thing that's left is exit liquidity. All right? So be sure to understand that. Being the exit liquidity on 100 billion market cap is not a good place to be. All right. So like I've always said, the higher you go into the rank, the lower the chances for you to stay there longer. Okay. So you can play the pump and dump scheme, but the higher the pump goes, the more dangerous it will be to be maintained. Okay. Because it requires exponentially higher levels of capital to sustain the Ponzi scheme. That doesn't mean these things tremendously worth zero. That just means over time, they either have to compete with better market shares, which is to me, very less likely going to change, or they inherently going to dilute to zero. Why is that? Because the revenue they can bring doesn't exceed the cost of blockchain. And if you don't understand that, boys, that's the basic of economics. That being said, I wish you guys a pleasant day. I hope you will now make more smarter investments. Beware of the bubble. I can't see the signs. It's already there. Be very cautious. If you're part of a bubble, at least know it. Get in, get out quickly, and take your losses. If you, for whatever reason, end up being the market top, just get the fucking hell out of here. And more importantly, don't ever put all your money into these things. If you want to gamble with 10% of your capital, well, at least, worst case scenario, you're going to lose 10% of the capital, okay? So I'm okay with speculating. I'm okay with pump and dumps, participating in those things. I'll never do it. Do it if you want to. The thing is that, yeah, it can bring tremendous rewards, the kinds of rewards you'll never get by trading conventionally. If you do this, I can tell you the controversy. I can tell you the opposite way and the opposite face of the coin is that you're going to get addicted to quick, short, easy gains. The reality is that the market isn't like that. So good luck learning trading that way. I think it's more dangerous over time. So if you play those pump and dumps, be aware that it can only be done during bubble phases. We do have one now, so you can do it. But it's a limited time offer. The more you play that game, the more you're going to feel like the way that this is the way the market is. It's not. I can definitely tell you for sure it's not. Don't be dumb. All right? I hope you're going to learn the lesson and not learning the hard way when you painfully be proven wrong. Until then, bye guys, and trade safe.